All right, let's get right into it. Today, we're looking at a fundamental rewiring of how businesses are valued. For decades, the emissions a company just pumped into the atmosphere, they were treated as a free pass, an unpriced externality that society just sort of absorbed. But, that era is rapidly closing. The source material we're unpacking in today's explainer reveals a massive paradigm shift. Climate risk is officially moving from a PR issue to a hard, quantifiable financial liability sitting right on the balance sheet. So it brings up a question that literally keeps CFOs up at night. What actually happens to a company's enterprise value when pollution finally has a price attached to it? Think about it. This takes the incredibly abstract physics of global warming and drops it directly into the concrete world of corporate finance and capital allocation. Okay, let's dive into this. We've got a clear roadmap today, starting with the cost of carbon, factoring risk into valuation, internal carbon pricing, the abatement decision, carbon offsets and their quality, and finally, what makes a net zero claim actually credible. Let's get going. First up, Section 1, the cost of carbon. Let's start right at the macro level. Global markets are finally doing what they do best, right? Assigning a financial cost to greenhouse gas emissions. To understand this cost, we really have to look at the two fundamental components of carbon markets. These are policy-enabled markets where scarcity is artificially created. On one hand, we've got compliance markets. Think of cap-and-trade systems like the EU ETS, where participation is mandatory under the law. No way around it. On the other hand, we have voluntary markets, where participation is entirely optional, driven by a corporation's own climate strategy and commitments to their stakeholders. Looking at these side by side, the differences are pretty stark. Compliance markets carry a much heavier financial stick. Because the demand driver is strict regulation, the price levels are generally much higher and the integrity requirements are legally binding. Voluntary markets, though, they're driven by corporate strategy, meaning prices are usually lower and the integrity standards are honestly still rapidly evolving. Moving right along to Section 2, factoring risk into valuation. Now here is where we shift from those broad market concepts into the mathematical realities of corporate valuation. Traditional financial modeling is getting a serious upgrade. You see, a traditional discounted cash flow, or DCF model, historically just ignored climate externalities entirely. It basically assumed the environment was free to use. But a climate-adjusted DCF, that systematically subtracts expected carbon costs right out of future cash flow projections. I mean, if you have to pay to pollute, your future cash flows are mathematically going to shrink. The specific financial mechanics here are absolutely fascinating. When extreme weather or transition policies hit, it increases a company's unsystematic risk, their beta. And when beta goes up, the cost of equity increases. That in turn pushes up the weighted average cost of capital, or WACC. And as we know in the world of finance, a higher discount rate mathematically guarantees a lower overall enterprise value. The market is literally discounting companies with high climate risk. Which brings us to Section 3, internal carbon pricing. So how do proactive companies survive this valuation shift? Well, they implement their own internal pricing to anticipate future regulatory costs before they even happen. Now, what's really interesting about this formula is how it completely changes the math inside the boardroom. This is your standard net present value formula, but with carbon costs explicitly embedded into the capital budgeting. The CF is your cash flow, but now you absolutely must subtract E, your emissions, multiplied by P, the internal carbon price. This single formula forces companies to evaluate the real net cost of their projects. It penalizes high emission investments and rewards long-term climate resilience. To really put this into perspective, let's look at a real-world scenario where a company had to model an additional $214 million in annual capital investments over 5 years, just for climate resilience. And when they ran that through their adjusted DCF model, it knocked over $860 million off their present value. Let that sink in. Climate risk is not some rounding error anymore. It is a massive structural cost. And because of these massive costs, financial analysts are watching metrics like this one intensely. Notice how it charts the intensity of CO2 emissions by unit of revenue over time. Investors use this to prove if a company is truly decoupling its financial growth from its carbon footprint. If revenue goes up, but carbon intensity doesn't come down, that company is essentially a sitting duck for future carbon taxes. Next up, Section 4, the abatement decision. This brings us to a critical junction for any business. Firms use these adjusted financial models to make stark, quantitative choices about how to manage their emissions. But Before a company even thinks about buying offsets, they have to follow a strict corporate hierarchy of decarbonization. Step 1, reduce emissions internally. Step 2, substitute with low-carbon alternatives, like renewable energy. And step 3, and literally only step 3, offset whatever residual emissions are left. Offsetting is the final step, not the first. That's a huge point.
So the crucial point is this core financial decision rule right here. Abate if MAC is less than P carbon. Let's break down exactly how a company calculates this marginal abatement cost, or MAC, step by step. To find the MAC, you take the net present value of a project's costs, including all the capital and operating expenses over its lifetime, and you divide it by the cumulative lifetime carbon abated. Let's look at two competing technologies. Imagine technology 1 is an HVAC smart retrofit. Because it generates massive energy savings over its life cycle, the math actually yields a negative MAC, minus $6.59 per ton. It literally pays for itself. Now, picture technology 2, an industrial biomass boiler. This requires heavy upfront capital, giving it a positive MAC of $26.43 per ton. Now, let's say the market carbon offset price, our P carbon, is $40 a ton. Our rule kicks in. Abate if MAC is less than the carbon price. Since both negative $6.59 and positive $26.43 are cheaper than paying a $40 market penalty, a rational company is going to finance both internal projects before ever looking at the offset market. This exact math is how compliance constraints and strict corporate claim standards like SBTI and VCMI force real-world capital allocation toward actual, tangible decarbonization.
Moving to Section 5, carbon offsets and quality. But what about those emissions a company absolutely cannot eliminate internally? Well, that leads us to the wild west of the voluntary carbon market, where companies go to address those residual, hard-to-abate emissions. Now, not all carbon credits are created equal. You really must understand the critical difference between avoidance credits and removal credits. Avoidance means paying someone not to pollute compared to a hypothetical baseline, like paying to protect a forest that might have otherwise been cut down. Removal credits, on the other hand, mean paying to actively extract CO2 from the atmosphere, like direct air capture technology or planting entirely new forests. And this brilliantly illustrates why carbon credits are viewed as risk-adjusted assets. For a credit to have actual verifiable value, it must prove additionality, meaning the reduction wouldn't have happened without the funding. It must prove permanence, so the carbon doesn't just re-enter the atmosphere if, say, a forest catches fire. It has to avoid leakage, where logging just shifts to the next town over. And of course, measurement accuracy is key. If a credit fails these tests, its quality drops, and it trades at a massive financial discount in the open market. Finally, Section 6, credible net zero claims. Because of these wild variations in quality we just talked about, regulators and standard setters are finally stepping in to enforce rigorous accounting. Honestly, we have to unlearn some old terminology here. The older, looser concept of carbon neutrality allowed companies to just buy cheap avoidance offsets to cover their current footprint without actually changing their underlying business model. But true net zero, as defined by the incredibly strict Science-Based Targets Initiative, or SBTI, requires a company to absolutely reduce their emissions by 90 to 95% internally. They can only use high-quality removal offsets for that final 5 to 10%. To help investors navigate who is actually doing this properly, the Voluntary Carbon Markets Integrity Initiative, or VCMI, created distinct claim tiers. Once a company proves they're on a credible, science-based decarbonization pathway, they can use offsets to supplement their journey. If they offset 10 to 50% of their remaining emissions with high-quality credits, they get silver status. 50 to 100% gets gold, and offsetting more than 100% of remaining emissions, that earns platinum. It provides a highly credible legal signal to the market that they are walking the walk. Which brings us to the ultimate question, doesn't it? We've seen the math, we've seen the internal carbon pricing, the marginal abatement costs, and these strict new standards. But can global markets actually scale these financial solutions fast enough to prevent systemic ecological shocks? By turning climate risk from a vague environmental concept into a strict, calculated financial liability, the capital markets might just be our most powerful engine for transition. Thank you for joining me to unpack this essential shift in today's explainer.